Awesome. Yeah, I want to make sure that we have time for Roger's class. So I'm going to move pretty quickly. And um, but we wanted to talk about gamma pockets, the gamma that we were um, that that Matt was asking about. He's like, "Hey, I really wanted to hear about gamma." So I want to make sure that I touched on that today. Suddenly I lost everything. You guys still see, are you guys seeing my screen or no?
Mm, I don't.
Okay. All
Now
right,
I
is that
do.
better?
Yep.
Okay, great. All right, thank you. And then I'll make sure I can see the chat.
We got it. We got it. We could see your screen.
Okay, excellent. So, just for a quick review, because it's been a couple of weeks, what we talked about before was that we really want to follow institutions. And for me personally, the institution that I like to follow the most is the market maker, or otherwise known as the options dealer. So, our policy, remember, we had our blueprint for predicting the future. The secret to predicting the future, we have our population, we have their policy, and then if we have their procedure, we can make really good predictions. So the policy makes the option market makers slaves to gamma. And I'll explain that in a little bit. So, and if we know their exposure and we know their activity, that how they're going to react to that exposure, that makes them highly predictable. So 2 weeks ago, I was trying to rush through the presentation. I was hoping to give you guys a bonus trade, and I wasn't able to do it. So a couple hours later in my Telegram channel, which only has one person, by the way, which is me. So don't feel like you're missing out. No one's has access to this yet. But on that same day, I went and I looked through something, and I looked at SMCI, which has been in the news the last couple of days. But I went short SMCI. But what's more important is that it was trading at 626.75 at the time. And I was able to identify a target where it seemed like the option dealers would be forced to start selling SMCI underlying stock. And it looked like they would sell it down to somewhere between 600 and 590, which would give us an underlying profit target of around 5%. And let's see what happened on August, what was that, 15th? 15th. Okay, we can see that over here. This was the 15th. SMCI was at that 626.69 at the close. And then the next day, when the S&P was up 1%, the QQQ was up 1.65%, SMH was up 1.88%. But what happened to SMCI? It went down 0.82%, which doesn't sound like that much. But look at the low. What happened to the low of the day? 595.28. And where did we think it could go because of the option dealer activity? Between 590 and 600. So that's pretty good. That's right in the middle of the range of where it looked like that there would be selling pressure to. And so on the next day or morning, Monday, because that was a Friday, on next Monday, we said that pre-market, the SMCI was down 1%. And that if that was enough for the 20 to 30% profit on the debit spread, we had a debit spread class that day too. So I was also implemented Roger's teachings into this particular option play. And we got out about an hour and a half later at 596.5, so $1 away from the low. And we made three 325 on 265. That was 23% on the option play, and it was about 5% on the underlying. So that's how predictable this can be. If you know exactly which institution is in control. So remember, market makers aren't always in control. Sometimes they get overwhelmed by institutions, by really big players. So you have to know, is the market maker the biggest player in the pond right now? Or is it some other institution? Sometimes it is the market maker, sometimes it's not. So I like the market makers because I can identify when the market maker is the biggest player and when another institution might be. And they're super easy to understand. I've basically already explained them to you. They're so simple. They have to make the bid and ask. They cannot play directionally. That makes them super easy to understand, super easy to speculate on, or not speculate on, to predict. So collectively, the other thing about market makers is that collectively, their entire position book is on public display. Okay. So, and based on their position, you can guess or you can derive because you know how how they operate, you know their business model, you know their policy, then you can guess what their hedging book looks like. So I think the beginning of Roger's story is something like he and a guy started a brokerage and they could see what the retail trader was doing. And every time they saw the retail trader, they just took the opposite. Am I right, Roger? Was that the story? Hopefully I'm not butchering that. So imagine if how big of a gold mine this was.
This is before the brokerage. This is when I was still in college. This is still when I was in law school. We joined Go Trading. We got a line finding what every other guy was trading in there, and me and this guy were taking the opposite trade. I'll talk about that sometimes, but that's a fun story. Thanks for reminding me. I will talk about that sometimes.
Yeah.
Go ahead,
and
please.
that was a gold mine because he could see what, and in this case, what the little guy was doing and take the opposite instead of following the institution. So imagine how big of a gold mine you would have if you could see Goldman Sachs or Buffett or JP Morgan, any of these big players, Soros, if you could see their entire book of investments and you could see what they were buying and selling. Could you make money if you saw that? I know I could. Maybe some people, the average person, if you don't have any experience, maybe you would say, well, maybe. I'm sure you could say, hey, Goldman just plunked down $10 million in Apple. You'd be like, okay, I'm going to buy Apple, right? It'd be so easy to make money if you could see their entire book of investments and what they were doing. And that's kind of the power of the Pro Trader dashboard and the pit. We don't see their entire book, but we do see their activity. But imagine you could see their entire book as well. Well, I can't see their entire book, but I can see the market maker's entire book. So how do I see that? Well, I guess I don't have a slide on that, but how do you see the entire book of the market maker? Well, that's pretty simple. That is, why can I move this? Here we go. Okay, so that is, if I want to see the entire book of the market makers collectively on Apple, this is all I have to do. It's the entire option chain. And this is on public display. Everyone has this. This is the market maker's book flipped backwards, right? If I look at the open interest on every single strike, on every single expiration, I know that the market maker wrote every single one of those calls and puts. So if I have open interest anywhere, there's 472, August 30, 185 calls, 472. I know that the market maker has negative 472. It's on public display. There's no other possibility because, well, the other possibility is that there's actually 500 of them and 28 of them were netted out because they were actually able to find a match. But it doesn't matter because those two are off the ledger and they don't affect the market maker at all or his decisions on how he needs to hedge his book. So the market maker's entire book of positions, or not the market maker, collectively, all the market makers added up together, but we can treat them the exact same because they have the exact same policy. They have the exact same business model. They have the exact same hedging model. They all operate the same way. They all have to behave the same way. So I can take them as a single entity. And because I see their entire book, and there's also something called options, times, and sales, I see all the order flow as well, then I can start to get ahead of the market makers and say, this is where their exposure is. This is where their exposure is. And if this happens, then they're going to have to hedge by doing this, by buying the underlying or selling the underlying. Okay? So how do we look at that? We look at that. Let's just take an X-ray vision into the market makers. So we all know the options Greeks. Some of us are probably not super familiar with them because we've learned that a lot of times they're just not that important for us when we're trading the options. However, if you are holding a book of options, if you have hundreds and hundreds of options strikes, options expirations, and different symbols, then you care a lot about the Greeks because this will tell you these are all the things that affect the price. And I need to know the things that are going to affect the price if I'm going to hold a book of them. Basically, the market maker has to hold these to maturity, to expiration. So, well, unless people close them. So a lot of people don't. They hold them to expiration. Institutions have a tendency to hold to expiration. So these options Greeks become really important to the market makers. So, but which ones do we care about? So if I'm a market maker, I know about delta. I hedge my delta. That's my number one risk. I'm going to hedge my delta. Vega and theta, those are time and volatility. They're working in my favor because generally I'm short the options. So I don't really care too much about that because those are usually working for me. Rho is interest rates that moves too slowly, so we don't really care about that. That leaves gamma. So what is the definition of gamma? Does anyone have a quick definition of gamma?
The rate of change of delta.
Rate of change of delta, right. So that's rate of change of delta is like, okay, how fast does delta move? In other words, if I wanted to know my risk for a small move, a $1 move, then I would look at delta. But if I want to know if for more than $1, $1 or $2, delta is not going to be that helpful. If I want to know what if it moves $10, $20, then I'm going to start looking at gamma. And remember, if I've already hedged away my delta, then my only risk left here is gamma. And that's why in an earlier slide, I said that market makers are slaves to gamma. So the definition of gamma, if you're an options market maker, is risk. I didn't put it. Risk. The definition of gamma for an options market maker is simply risk. It is the number one main risk to the options market maker. Okay. So yes, the gamma is definitely the highest right up to expiration, which is why that SMCI play was off of options expiration. That makes it a lot more predictable, those options expiration. But in between, we can still use gamma to see how market makers are going to behave. So let's see if this pen works. So this is how gamma works, right? This is the curve for gamma. If you're at the money, then gamma is higher. And the further away from at the money, then the effective gamma is lower. What that means is that if the current price of whatever underlying is 100, and we have a huge exposure at 150, I'm not going to care that much. If I'm an options market maker, I'm not going to do that much hedging because I'm so far away and my gamma is negligible. But as I get to 125, what you see is that this curve starts to go up really sharply. And the closer I get to at the money, the sharper this slope is until I get really close. Only when I get really close does it start to taper off. So what that means is if I'm at the money here and we have a bunch of long calls, or in other words, the market maker is short calls, then what the market maker has to do is when we move from 100 to 110, the market maker has to buy, let's just say, 1,000 shares in order to hedge their position. When we get to 125, then they've got to buy 5,000 shares. And then when we get to 145, suddenly they have to buy 50,000 shares. Okay? So what that means is they're buying more and more as we get closer and closer to a particular strike. And that buying activity on the underlying, it may not be meaningful over here, but it gets pretty meaningful over here. And so now they could be entering into the territory where they're actually affecting the underlying price, and they're forcing the underlying price to that 150 strike. The opposite is true on the way away from 150. So here they would start selling the same 50,000, and then they would sell 5,000 and 1,000. And so because of this effect, this strike ends up being a magnet. The closer we get to it, the more likely is the market maker's activity is going to start attracting the actual underlying price to that actual area. Of course, that depends on overall exposure. If there's only like 10 contracts at 150, then no one's going to care about it. If there's thousands of contracts at 150, then that's going to create a much stronger effect. So is there a way to optimize both theta and gamma? There are, but they become a lot more complicated option strategies. They're not going to be the simple buy a call, sell a put. How is market maker behavior different from retail sellers? That's a great question. So a retail seller is going to be selling because of speculation. They're going to say, oh, I think that we're going to go to 150. So let me sell a put or whatever it is, whatever their strategy is to speculate on 150. The market maker doesn't care. The market maker is only the bid and ask and bid and ask. The market maker doesn't care where the price is going to go. The market maker doesn't care about trends. It doesn't care about technicals, doesn't care about anything. It doesn't even care about liquidity. So if right here, we are talking about a stock on, just say today, where we only have 10 million shares in the SPY trading today, and normally we're expecting 50 to 100 million. If they get close to this 150 and suddenly they have to buy massive amounts of stock, they don't care that only 10 million have traded so far. If my model tells me I need to buy 5 million, I need to buy 5 million. I don't care that today's volume was 10 million. I have to. I am a slave to my risk. I'm a slave to my gamma. So if today's volume is 10 million and suddenly I have to buy 5 million, do you think that's going to have a big effect on that stock price? The answer is absolutely. So there's certain conditions where the market maker's behavior is going to absolutely dominate the market for that in that moment and in that day. And that because we know their risk, we know their book, and we know their positions, and we know what they're going to have to do. If we see those certain market conditions, then we can catch a very fast, like speeding bullet towards a magnet. And that's how I trade. That's what I'm looking for in these gamma pockets. I'm looking for these areas where they're going to be magnetic and just swing towards that with high speed. Of course, conditions aren't always perfect, and so sometimes we take trades that don't look like they're going to go with super fast speed, but they still have a really high probability of hitting that target. Okay. And sometimes you have skew. It's not a perfect line, like curve, like we showed in the previous one. Sometimes there's skew, and that gives us information also. So, hey, are puts more heavily favored, or calls more heavily favored? Okay. So the risk to the market maker, the gamma exposure, we can calculate gamma. We can calculate gamma for every strike, or actually that's given to us. And based on that gamma and based on the options, the open interest, we can calculate the market maker's exposure. And if we do that for every single strike on every single expiration, and then you add that all up together, then we know the market maker's total exposure in their entire book. And what that ends up meaning is for 1% move in the underlying, either up or down, then the market maker is going to be forced to sell X number of million or X billion dollars of underlying, either sell or buy, depending on which direction. Okay? And if that number gets to be a very large number relative to the volume that we normally see in a day then that's going to be a significant move. That's going to be one of those speeding bullets that we were just talking about.